Welcome to Independent Wealth Planner Strategies with Jennifer Lang, helping pre-retirees and retirees build, preserve, and protect their financial assets in today's volatile market.
Welcome to today's webinar. I'm Mike Payne, and your host for today is Jennifer Lang. Jennifer is an author, a speaker, and a licensed financial services professional who found her love for financial literacy the hard way. Her career goals were on track as she tackled the hustle and bustle of working in New York City as a corporate manager. That is, until life threw her a curveball that would change her direction. Her mother became ill, and Jennifer only had one choice. She left New York and became her mother's full-time caregiver. It was during this 10-year period that Jennifer learned firsthand the importance of how life insurance protects an individual and a family while they are alive, as well as how having long-term care benefits in place can empower family members and relieve burdens. She found a new passion and purpose to help the underserved middle class protect against the emotional, physical, and financial stresses of caring for their loved ones. Currently, she works with businesses and families in all 50 states to acquire business loans, life insurance, and annuities. She is contracted through One Resource Group, and you can contact her through her website, JenniferLangFinancialServices.com. So, without further ado, Jennifer, take it away.
Thanks, Mike. I'd like to welcome and thank everyone for attending today. My name's Jennifer Lang, and this webinar is being recorded and will be available for rebroadcast later on. So, please submit all questions via our website, JenniferLangFinancialServices.com. Today's presentation is going to be a little different. We're launching our financial education ebook series, and Volume 1 is now available on my website for free. It's entitled How Women Can Prepare for Retirement Now. And today's presentation is going to be a replay of a phone interview I did with Marcus Hart on the Transform You Network. So, if you have any questions or concerns during the course of this presentation, I invite you to take advantage of our complimentary phone consultation. During the consultation, we can discuss your questions and begin the process of helping you develop a financial strategy customized to your goals and time horizon. So, let's find out all about the book.
Hello and welcome. I'm here with our guest, Jennifer Lang. And by the way, I'm Marcus. Jennifer is an asset and retirement protection company specialist. Jennifer specializes in working with people who are near retirement or already retired with wealth management, income planning, asset protection strategies, and she is here to talk with us about no market risk retirement planning. Jennifer has written a new interaction ebook entitled How Women Can Prepare for Retirement Now. And if you like a copy, it's available for free via her website, JenniferLangFinancialServices.com. You can find it under the ebook selection. So Jennifer, tell us, is this book just only for women?
Hi, Marcus, and thank you for having me. No, the general information in the book is applicable to both men and women. However, in spite of the fact that women have over 51% of the spending power, women tend to invest for retirement far less than their male counterparts. So I wanted to address that inequality in regards to the needs of women, right? But anyone can read and learn from the book.
Great. So Jennifer, tell us a little bit more about the book.
Well, Marcus, my new book, How Women Can Prepare for Retirement Now, gives readers details about safe, no market risk saving and retirement planning products and how they can earn steady growth returns without any of the market risk, how they can eliminate the fees that they're now being charged by the broker, and how they can start feeling secure knowing that their retirement money is safe and growing. We use safe, no market risk strategies based on specialized products that can provide contractual guarantees that you'll never suffer a loss because the stock market declines, while locking in your yearly gains with no fees or loads taken from your deposit. My message is different from what you normally hear on financial planning shows, largely because our concepts are different. For starters, our emphasis is on preservation of your principal, participation in market gains, and a lifetime of income that you can never outlive. Our planning prepares you for retirement you can count on. Now, I often say that I learned about retirement planning and aging the hard way. One minute, I'm a corporate manager working in New York, right? And overnight, my life changed. My mother got sick, and I left New York for what I thought would be 2 to 3 weeks. You know, a week in the hospital, a week out of the hospital, and a week to make sure she was really okay. Because in my mind, my mother was Superwoman, right? She was a school teacher, and she never, ever, ever took a sick day. She never, ever, ever let the weather stop her. In fact, nothing stopped her. So I figured she'd kick whatever this was, and life would be okay. But it didn't work out that way. She was sicker than I knew, and what's worse, it was a debilitating sickness. So those 2 to 3 weeks turned into 10 years as her full-time caregiver. That's what I mean when I say I learned the hard way. I learned the hard way about retirement planning. I learned the hard way about long-term care and how much it costs. I learned the hard way about the realistic needs of aging. So by the grace of God, I've been able to use that experience to help individuals, families, and small business owners be proactive rather than be reactive. Because at the end of the day, as we deal with coronavirus, right, I think we can all agree that when you get hit by something you didn't see coming and you don't already have a plan in place, there's fear, there's chaos, in a lot of cases, there's financial destruction, right? So being that we know retirement is coming, aging is coming, I wrote this book to help give people a tangible plan. After going through all of this with my mother, one of the things I focus on in the book is long-term care planning. One of the biggest misconceptions about long-term care is that people think that Medicare will pay for it. Fact is, Medicare only pays for 100 days. So if you are not back on your feet in 100 days, what's your plan B? How are you going to pay for it? And where is the money going to come from? My mother didn't have a plan for long-term care. We had to pay out of pocket for extra help to come into the home and help because my mother needed 24-hour care and, I couldn't do it all by myself. So I kept the costs capped at $35,000 a year. But for 10 years, that's $350,000 cash out of pocket. Now, the average cost of a nursing home nationwide is $100,375 per year for a private room. And although the costs vary state by state, if we had to pay $100,000 for 10 years, that would have easily been over $1 million. And that's not factoring in the cost of inflation. So including long-term care provisions in my retirement planning strategies is very important to me because aside from the ever-increasing cost of medical care in this country, making sure that as you come to the end of life, you need to be able to face it comfortably and with dignity.
Wow. That's a lot to think about. We never look at elderly people and say, one day that will be me. We always see ourselves as indestructible, Jennifer. The coronavirus is showing us just how fragile our healthcare system is. Healthcare workers can only handle so many patients at a time.
Exactly. In addition to the coronavirus, America's healthcare system is going through huge changes in preparation for the growing medical demands of the baby boomer generation. Over the next 3 decades, the United States will see unprecedented growth in its senior population as the baby boomer generation, which is defined as those born between 1946 through 1964, as they age. Increases in healthcare demands will be seen throughout the healthcare industry, with the greatest impacts anticipated in hospitals, skilled nursing, assisted living, and residential care facilities. Many Americans don't want to think about the day they can no longer live independently and take care of themselves. But the truth is, 70% of Americans 65 and above will probably require some form of long-term care due to old age, illness, injury, or accident. And unfortunately, many individuals make the mistake of waiting too long to plan for long-term care. Sometimes it's too late, and they already need long-term care.
So, when is the best time for long-term care planning?
The short answer, right now. Long-term care expenses in the United States are high, and delaying having a good plan could significantly affect your finances. There might come a time where you can no longer be able to carry out some of your daily living activities. So taking the necessary measures to ensure that you get the best long-term care to meet your needs is the best proactive step. What makes matters more troubling is that family members also find themselves at risk physically and financially after they take the responsibility of taking care of aging parents. Long-term care refers to the services and support that an individual might need to maintain his or her quality of life in the event of illness, disability, or sudden impairment. The type of long-term care covers the assistance in completing the activities of daily living, or what's referred to as ADLs, okay? These tasks include the following: eating, bathing, dressing, toileting, continence, transferring. So think of it like the first 20 minutes of your day, right? So while the definition of long-term care might lead some people to think that it is the same as medical care, these two are different. On one hand, medical care concentrates on treating the illness in order to improve health. However, on the other hand, long-term care focuses more on maintaining the person's functionality and routine.
Wow. Once you break it down, then it's really easy to understand how 70% of people over 65 may need some form of long-term care assistance. So here's a question. How do you plan for that? Because the majority of people's retirement money is attached to a 401K or an IRA. So how can they protect that money against the stock market going down and cover long-term care costs at the same time?
Well, Marcus, this is what we do to ensure that your hard-earned money is 100% safe from any and all market losses. We stay away from stocks, bonds, mutual funds, and variable annuities. You see, when you suffer a loss in the stock market, even a small loss, you have two problems. First, when an investment loses value, that lost value is just one problem. The second problem is the time it actually takes to make back that loss. That is, if you can even make it back at all. Your money cannot be working for you if you're losing. That money could be gone forever, destroying your opportunity for compounding. So first, if you lose the basis, that is your funds, right? You have lost the main ingredient for compounding that was working for you until it was lost in a market downturn. In addition, you lost time that is now needed to just replace what you originally had. Without time, there can be no compounding, crippling your whole retirement plan for a quality future. Any financial professional will tell you that losses to your portfolio could severely limit your lifetime income and possibly cause you to run out of money decades sooner than projected. Our advanced planning keeps that tragedy from happening. We use life insurance-backed products through A-rated carriers that can guarantee no market risk to your funds and no management fees. Our strategies move your compounded growth forward, never backward. We've helped clients all over the country protect millions of dollars in just the past several years, and not one of them has lost a single penny, even in one of the biggest stock market catastrophes in U.S. history.
With the economy and unemployment, the stock market isn't exactly stable right now either. I mean, just watching it fluctuate so much recently, it's clearly unstable. Are we about to sink lower?
Well, that's a great question. And to be completely honest with you, I don't know. You don't know, and for sure, your broker doesn't know. Now, if he knew when the stock market was going to turn around, he would have taken you out of the market. Of course, a bear market could last for years. The average down market is about 18 months. That's a year and a half. It takes us longer to process events. So if we think about the worst case scenario, what would 3 to 5 years of market declines and volatility look like for your portfolio? If you are within that retirement red zone, and the retirement red zone is defined by financial planners as those 10 years before and those 10 years into retirement, can you afford to wait several years or more after a downturn just to break even? And that's if you can ever get back to even. When we look at losing money in the market, it's more than just the value of the funds lost. It's also the element of time. It's going to take, and no one can place a value on that. The older we get, the more valuable that time is, simply because we don't have the same amount of time left to live. We offer a free complimentary consultation along with the book. So we would address advanced planning strategies, and here's how we address it. If you're never in a position to lose money, you don't have to spend time trying to get back to even, right? So no market risk retirement planning is just one of the strategies we embrace for our clients. Our clients never lose any of their principal. Our clients' money is contractually guaranteed to never participate in market downclines, only market gains. So our contracts even have a lifetime income account that guarantees compounded annual growth and also guarantees that you'll never outlive your money, along with long-term care provisions. The advantage of using life insurance-backed products to hedge against risk is that your gains are locked in and you'll never experience a loss due to market decline. And they always grow tax deferred, because taxes are another enemy of growth, causing losses to your account.
Jennifer, not everyone can afford a financial advisor from Wall Street, but I remember hearing a quote about Warren Buffett, who is one of the richest men in America, who said, there are 2 rules that every investor should live by. The first rule is never lose your money. The second rule is never forget the first rule.
Yeah. Warren Buffett, better known as the Oracle of Omaha, is a funny dude. He's a sweet, funny dude. But he's serious because losses are never good, and no losses of any kind are allowed in our retirement preservation strategies. With our no market risk plans, you gain when the market gains, and you do not lose when the market goes down. In fact, I can show you examples highlighting the possibility of gaining even during a losing market. You can never lose due to market losses, and this is guaranteed by multi-billion-dollar A-rated companies. So after a down market, you never have to take even more risk trying to get back to even because you never took a loss in the first place. Once the market starts going up again, you get a nice portion of the gains. The bottom line is that the clients we work with are people who have money they can't afford to lose. It's important. It's so important to remember that making money is not trying to get back to even. It's gaining while never losing money in the first place. We can structure plans with penalty-free exits and rollover strategies to maximize your gains and remove risk of loss.
So how does a person know if no market risk retirement planning is right for them?
That's a good question. Now, when I speak with clients, I usually ask each one of them if they're ready to give up the worry and anxiety for some security and safety. And here's another question I ask. How much of your money is currently in the market? 50%? 80%? All of it? Did you make a conscious decision to have that particular percentage exposed to market risk, or did it just sort of happen? Now, there's a reason I'm asking that. As I've said before, the markets go up and the markets go down. How much of your life savings you allow to be exposed to market risk is a very important consideration. That is why I strongly encourage everyone to think about their money in terms of colors. For example, red money and green money. Now, at first, red money and green money may sound odd, but I believe that they'll help us understand a very important concept. Red money is money that you are willing to expose to market risk in hopes of higher returns. You accept the possibility of losses, even significant losses, in hopes of greater gains. Red money is exposed to upside and downside market risk. Green money, on the other hand, is about safety and security. With green money, you are not willing to accept the risk of losses. So instead, you are willing to accept a lower return in exchange. Green money does not have downside market risk. So if red money is exposed to upside and downside market risk and green money has only upside market potential, which one is better? Well, in the real world, there is no right or wrong answer because neither one is inherently good or bad. It really all depends on a person's risk tolerance. The real questions you should ask yourself are, what percentage of my money should be in red money and what percentage of my money should be in green money? That's a different perspective, right? So when you ask yourself, what percentage of my retirement savings can I afford to lose versus what percentage of my retirement savings can I not afford to lose?
So wouldn't a lot of that way of thinking be dictated by where we are at in life?
Exactly. Your age and how close to retirement you are dictate your planning strategies. Okay? If you are at or near retirement, you should ask yourself if any of your money should be in red money Can you afford to lose any of your retirement funds? Are you comfortable taking 2 steps forward and 3 steps back? Or would you rather just take 1 step at a time and never take a step back? Here's the biggest key. Red money is good for the young and the rich. The young have time on their side and can afford to lose money in the hopes that they will make it back in the future. The rich can afford to at least lose some of their money and still live comfortably. But if you are at or near retirement, I can't stress this enough, you should definitely be in the green money circle, which is money that cannot be lost due to market declines. Many people believe that all retirement money should be in green money. Personally, I think that makes a lot of sense. Many people I work with, regardless of their age, want 100% green money because they know they can have upside market participation without accepting any downside market risk.
You know, we heard and read a lot of stories of people who are in their retirement years and don't have the money they thought they would have. I mean, they put a lot of risk.
Yeah. It's really scary. Okay, it's really, really scary when you look at the numbers. 40% of Americans, 40% of Americans over the age of 60 who are no longer working full-time rely solely on Social Security for their income. The median benefit is about $17,000 a year. Every day, 10,000 Americans reach the age of 65. In 2024, that number will crest at about 12,000 a day. And every year, fewer and fewer of them have traditional employer-sponsored pensions to support them. The system that was supposed to provide for them is shot through with holes. According to a Boston College study that was completed before the pandemic hit and potentially made the prospects even worse, half of Americans are at risk of not being able to maintain their standard of living in retirement. Dozens of factors have contributed to this, most having to do with lack of access to retirement savings plans, unexpected large financial hits, layoffs, and declines in health. A study at Stanford University found that baby boomers have, in real terms, about 20% less in savings, 20% lower household wealth, and 100% more debt than a generation born during World War II. Despite their popularity today, 401K plans were created almost by accident. It started when Congress passed the Revenue Act of 1978, which included a provision that was added to the Internal Revenue Code called, get this, Section 401K. I love it. That allowed employees to avoid being taxed on deferred compensation. In 1981, the IRS issued new rules that allowed employees to fund their 401K through payroll deductions, which kickstarted the 401K's popularity. Within 2 years, nearly half of all big companies were offering 401Ks or were considering it, according to the Employee Benefits Research Institute. Now, the entrance of 401Ks represented a dramatic shift in the way individuals became involved with saving for their retirement. The responsibility for choosing and monitoring investment performance of retirement fund assets also shifted from the employer to the employee. So, before picking assets for your 401k, you need to know your risk tolerance and the investment time horizon of the plan. It's important to stick to the asset allocation you choose and make any adjustments on a semi-annual basis. Because the employee is solely responsible for his or her retirement savings, over the years, what we've learned is that having green money provides an enormous benefit, a tremendous sense of comfort and relief for the person making the decision. Now, if you think about it, when your retirement savings or a portion of your retirement savings is allocated to green money, the worry goes away. This is a stress test, okay? If you have red money losses and get upset, then probably that money should not have been in red money type of investments. So this is what makes it easy to decide. You ask yourself this question: if I were to lose some, most, or all of the money in this account, would I be upset? Now, if the answer is yes, then your money should be in a green money account that isn't affected by stock market risk.
Jennifer, what green market or rather green money options are there other than what cash, checking or savings account, or I guess green bank CDs?
Yeah, bank CDs, yeah. Well, Marcus, this is where I really get to help people, okay? In my book, you'll learn about options that have upside market potential and are not exposed to market risk. And some come with upfront bonuses of up to 10% and have a minimum guaranteed income account growth factored in. When I talk to clients, I'm mindful of the fact that these are people with lives and families. And after being my mother's caregiver, I've already been given a glimpse of what we will all have to face at the end of our journey here. Life is uncertain at best. Most people I talk to that retire look back on their life with a fair amount of satisfaction, but also with some regret. So they're looking forward to a new chapter in their life to do some things differently. Maybe, new relationships, or tend to an old one that needs healing. They're looking forward to new opportunities to serve or invest in the lives of those they love. And most are eager to no longer be a part of that rat race, right? They want to breathe in life, but with so many things threatening the market, threatening their peace of mind, like pandemics, trade wars, politics, national debt, tremendous volatility in the stock market, and global economics. I want to give my clients one less thing to worry about. The more time I spend with clients focusing on green money options, the more good night's sleep my clients get. Now, hindsight is 20/20, all right? Looking ahead and making wise choices to protect your retirement savings requires an understanding that waiting is an invitation to loss and regret. Turning red money into green money is like magic. That danger falls away, replaced by peace of mind and contentment.
So, Jennifer, what you're saying is you focus on putting together a retirement plan for living rather than a retirement plan for dying.
Well said. Well said. That's exactly what I do. I bet most people listening would tell you they want a retirement plan for living. But unfortunately, more than 90% of retirees have a plan for dying, even though they want a plan for living.
Then what's the difference between the two?
Well, many people have retirement funds in variable products. In other words, products that are at risk due to stock market loss. They are not appropriate for this stage of life. For many years, conventional wisdom in America has taught those saving for retirement to build up a big pile of money before they retire. The problem is, what do you do with it now? Traditionally, financial planners put them on a plan so that by the time they retire, they'll be able to withdraw about 4% out of their big pile of money to live off of. And that 4% is usually a mix between the interest they're earning and then maybe a little bit of their principal. So they are at least keeping the pile intact for as long as possible, right? So if you don't draw out more than 4%, your money should last the rest of your life. You know, that sounds reasonable. But unfortunately, when it comes to the rate of growth, inflation, management fees, and market downturn risk, this 4% theory is based on assumptions. For example, if you were drawing out 4% and experienced a 20 to 30% loss in your variable retirement accounts like most people did in 2008, what if your management fees went up? Just like variable investments have risks, so does the assumptive planning that is used with these products. It's risky. According to an article in Morningstar that was published in April of this year, it said that a 4% withdrawal rate may be too high for today's retirees. Now, in that article, they interviewed retirement researcher Dr. Wade Pfau. Now, Wade is a professor of retirement income in the Financial and Retirement Planning Program at the American College of Financial Services. He is also co-director of the New York Life Center for Retirement Income. He holds a doctorate in economics and a master's degree from Princeton University and Bachelor of Arts and Bachelor of Science degrees from the University of Iowa. He is also a chartered financial analyst. Now, in this article, they quoted financial planning research that Wade Pfau did. In Dr. Pfau's research, it was evident that the 4% rule cannot be counted upon it and is no longer safe. This research was based on historical results in the stock market and included extensive backtesting with different stock and bond allocations.
So what were the results?
Okay, so Dr. Pfau wrote that it's important to understand that the 4% rule does not apply today and that the 4% rule is essentially broken in today's environment. Reason being, people are living longer. And the 4% rule ignores taxes. It assumes investors are not paying any fees on their investments and so forth. But the biggest driver for what we're seeing happen in the economy right now is low rate or low interest rate environments. To quote Dr. Pfau, okay, he says, and I quote, "Low bond yields mean low bond returns in the future." And there's not really any controversy about that. It's a very close mathematical relationship. If interest rates don't change, today's bond yields will be the bond returns. And then, of course, if you're holding bond mutual funds, well, if interest rates go up, you're going to have capital losses, which make things even worse. Or vice versa. If interest rates decrease further, you could have capital gains. But effectively, future bond returns are going to be very close to today's bond yields. And that means spending from bonds is going to be lower mathematically. And the 4% rule is just based on U.S. historical data, where we've never seen interest rates this low before. So if you are just trying to fund retirement with bonds, you are pretty much looking at about 2.5% withdrawal rate for a bond portfolio rather than the 4%. Now, while the results were shocking to many financial planners, it showed that the safe withdrawal rate for fixed income vehicles such as bonds at times is 2.5%. That means, for example, let's say you had $1 million, okay? The most you could pull out in a year would be $25,000 in order for the average person to not outlive their money. What's even worse is that this research did not even include the fees that come from investing in variable products. Now, once you factor in the fees, which can be more than 1.5 to, maybe 2% at times, it becomes very clear why a 4% rule withdrawal rate may be too high. Now, if you're counting on the 4% rule and you're using an account subject to risk, high fees, and assumptions, you'll never know for sure how much you should be withdrawing. It's a risk. And imagine the moment that you were about to run out of money. It seemed like a good plan at the time, but now you're watching your account move to zero and wondering what you're going to do from here. Especially when you got a lot more living to do. This is when you suddenly realize that your plan was a retirement plan for dying. The only way your funds were going to last longer than you was for you to die too soon, right? Now, I don't want you to experience that moment. We have a retirement plan for living and not dying, and not worrying about your account dwindling to zero, even if you live to be 100, or in some cases, we can work it out to 120. You never know. I wrote this book to let people know that there is a better way and a safer way. So please take some time to think through this, okay? The truth of the matter is, most people spend more time planning their vacation or a wedding or a family reunion and some other type of event than they do planning their retirement. Making the wrong decisions can be costly, and you could pay for it for the next 20 to 30 years.
So, Jennifer, what you are saying is retirement planning can be pretty challenging if you have not prepared ahead of time for life and the changes of life.
Yes, that's right. The changes of life. That's good. It's important to assess your savings for retirement throughout, but it becomes more critical during the retirement red zone. Remember, 10 years before or after retirement are regarded as a red zone, okay? How your retirement portfolio behaves during this time determines your standard of living after you retire. Now, the good news is that you can prepare for a happy and smooth sailing retirement by knowing about the challenges of this time period.
So, where should we start?
Okay. Well, the first thing to do is determine your risk tolerance. Okay? When you are only a decade away from retirement, you're probably looking to preserve your savings. During this time, you should especially plan for risks that might come your way if you retire in a bear market. 10 years away from retirement, your retirement portfolio should focus on high-quality stocks and investment bonds. This can help you generate more income for your golden years, all right? The second thing is to protect against sequence of returns risk. Retiring in a bear market is much more damaging than a downturn after a decade or so into retirement. Not only will it have a negative effect on how much you can withdraw, but it will also cause poor returns later in retirement. Protecting against sequence risk A decade before retirement means anticipating what could go wrong in the future. You can protect against sequence risks before and after retirement in the following ways. First, keep working as long as you can to save more for retirement, especially in your peak earning years. Open a personal investment account and make the most of those earnings. Second, keep saving and investing even after you retire. Workers with an individual retirement account used to only be able to contribute up until the age of 70 and a half, but that age limit has been removed. The Secure Act allows you to continue contributing to your IRA at any age as long as you are still working. Diversifying your portfolio by investing in high-quality, dividend-paying stocks. You can also invest in government bonds to expand your portfolio. Now, although it's true that during the years you're saving for retirement, if the market drops, you may have time to rebuild your assets that are subject to market volatility. But once you start withdrawing your money, that's when market volatility can have a big impact on how long your assets will last and how comfortable you can live in retirement. One factor in how big an impact is your sequence of returns. That's the year-by-year returns that your retirement assets continue to experience while you're drawing on them for retirement income. Here are a couple of examples. Say you're retiring with a nest egg of $1 million and you plan to withdraw $50,000 per year with a slight increase every year for inflation. Meanwhile, your remaining asset, that remaining nest egg, is still invested and still subject to the ups and downs of the market. Now, of course, we can't predict those ups and downs, your sequence of returns, but let's say, for example, that in your first year of retirement, you get a really good return and you're up 27. And the next year you get another positive return and you're up 9. Not as good as your first year, but, still positive. Then in year 3, a little less, up 7. But then in year 4, the market drops and you take a loss of negative 15 and you're down. Now, with compounding, you'll average a good positive return over those 4 years of 6%. So let's keep repeating that sequence of returns in the exact same order until your annual withdrawals have completely used up the asset. Now, in this example, that's 38 years of income. I mean, that's not bad. But what would have happened if you had started withdrawing money in a down market? To find out, let's take those same numbers, and this time we'll reverse the order. You still get the same compounded average, but this time you're starting out with a significant loss. So let's say you're down 15. Then an okay gain the next year, you're up 7, right? And then a better gain the next year, you're up 9. And then a really good gain, you're up 27. And as before, we'll keep repeating that sequence until your annual withdrawals have completely used up the asset. But in this example, it happens about 13 years sooner. You have lost 13 years of income, and only because you got the same returns in a different order. Now, of course, there's no way to predict the order of your returns, whether it'll be an up market, a down market, or a flat market when you start to retire. However, there are potential retirement income solutions that can provide protection against losses due to market volatility. And these solutions can also be a source of guaranteed income for your retirement years. Remember, every additional year your assets last could mean fewer financial worries and a level of comfort. The book talks about great solutions for a lot of basic retirement concerns. that not only protect your hard-earned money, but also provide a solution to the longevity risk. Here are two major benefits of no market risk strategy, okay? The first is the top benefit, all right? Secure your principal. Even with stock market volatility, they do not lose value. This means your savings will not be subject to market fluctuations. You will never lose your interest after it is included in your principal, okay? The second benefit is to provide a solution to longevity risk. As the average human age is increasing, it means you have to provide for yourself during retirement for a much longer time. A longevity risk can stretch retirement income thin. Moreover, long-term care costs can devastate your savings for retirement. Our no market risk strategies provide guaranteed lifetime income so you can never outlive your earnings. What's the bottom line? Retirement planning is not something that you can put off for later, especially if you are just a decade away from retirement. Take professional help and invest in safe, no market risk strategies to get rewarding outcomes of a secure future.
So Jennifer, for those of us who are not in the red zone and we're under the age of 59 and a half, what can we do to protect our retirement savings or even a portion of it?
Okay, now, if you're still working and saving for retirement, maybe you can take these market drops in stride because your investments have time to recover. But if you're within a few years of retirement or recently retired, this volatility is a reminder to adjust your strategy. Big losses, especially in the early years of retirement, could derail your finances if you haven't planned for them. Economist Mohammed El-Arian told CNBC on February the 20th of this year that investors should hold off on buying equities that were hit hard in the latest coronavirus-driven plunge. As Mr. El-Arian said, and I quote, "I stress this is different," unquote, the Allianz chief economic advisor said on a Squawk Box interview a day after the Dow Jones Industrial Average plunged over 1,000 points or 3.5% in its worst single session in more than 2 years. Just because buying market dips has worked in the past does not mean it's going to work this time, he said. I would continue to resist as hard as it is to simply buy the dip. Disruptions to corporate earnings and economic growth from shock events such as the coronavirus tend to stick around longer than more fundamental downturns, said El-Arian. Now, we're going to have a lot of risk aversion on the part of economic factors. It's going to take time, he said. Economic sudden stops are hard to restart. So what do you do if you are still working and under the age of 59 and a half? The Internal Revenue Service implements certain rules for when you can and must take early, qualified, or required distributions from a 401K retirement plan or an IRA. You can face tax penalties of 10% to 50% if you don't understand and follow these 401K withdrawal rules. So to protect your retirement savings under the age of 59 and a half, you could consider an in-service rollover through a qualified distribution.
So if we're still working, the first thing we need to understand and consider are qualified distributions. Is that correct?
Yes, very good. That's correct. Ding, 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 ding. Qualified distributions are made tax-free and penalty-free from a qualified retirement plan. This typically means that they are taken after age 59 and a half or under some extenuating circumstances. There's no penalty for withdrawing your money after age 59 and a half, but you'll pay ordinary income tax on the distributions if you've invested in a traditional pre-tax 401k or a traditional IRA. Now, Roth IRAs and Roth 401k contributions are made with taxed dollars, so this rule doesn't apply to them. The main thing you need to remember is that you have options, okay? You can roll over your IRA, 401k, 403b, or lump sum pension payment into an annuity tax-free. Annuities are funded with an IRA, or rather, annuities funded with an IRA or 401k rollover are qualified plans, okay? Enabling an insurance company to create an IRA annuity into which you can deposit your retirement funds directly. The Secure Act, I know a lot of people haven't even heard of it, huh? The Secure Act allows you to shield up to $135,000 or 25% of your 401k into a qualified longevity annuity contract, which is known as a QLAC, okay? Now, when you buy a QLAC, and you get that from a life insurance company, you subtract the amount you contribute from your total retirement assets that are used to calculate your required minimum distributions, those RMDs. Okay, so you'll defer taxes on the amount you invest in the QLAC until you start taking payouts. Meanwhile, you are guaranteeing a pension-like income stream later in life, reducing the risk you'll have to withdraw money during a bear market, and the bigger risk you'll run out of money entirely.
That's really interesting, because what you're saying is that the government basically wants us to use annuities in our retirement plans, right?
Yeah. An annuity spreads out that longevity risk and helps ensure a steady income for however long you might live. Now, let me ask you a question. What was the original annuity?
The original annuity?
Mm-hmm.
I don't know. What was the original annuity?
Social Security.
Wow.
Social Security is the original annuity. And we love Social Security, right?
Indeed.
It gives us guaranteed income for as long as we live, and that's what an annuity does. An annuity is a contractual guarantee that you will never lose money. Now, let's put two and two together so we can understand the why of your question, okay? The Secure Act, which President Trump signed into law December 20th of last year, 2019, eases rules so employers offering a 401k plan around how they can choose an annuity provider, okay? Many business owners had been concerned that the old regime exposed them to too much legal risk. The Secure Act, which is the biggest overhaul to retirement law in more than a decade, strips away some of that worry for employers. It makes it more likely that employers will offer annuities in their 401k. The basic function of an annuity is to provide investors a guaranteed stream of cash in their retirement year. Remember, just like Social Security, you can count on it. Consumers pay a premium deposit to a life insurance company, which agrees to immediately or years in the future pay consumers a recurring amount of monthly income for the rest of their lives. The U.S. Social Security system is essentially a massive annuity program into which working Americans pay every time you get that check in order to receive Social Security checks beginning as early as age 62. You see how that works? You get your paycheck, employer pays into Social Security, it gets locked away until you're age 62, then you start to get a monthly check. Okay? So some financial experts say consumers should have enough annuity income, including that from Social Security, to cover fixed expenses like housing and transportation in retirement. Corporate America's gradual shift from pension plans toward 401k type plans has led some policymakers to advocate for the inclusion of annuities in more workplace savings programs. Pensions, just like annuities, provide a guaranteed income stream to retirees, but 401k plans don't give such certainty. Remember, the stock market is never, ever, ever going to give you a written guarantee that you will never lose money. The stock market comes with a disclaimer that says, trading and investing involves risk. Please do not trade and invest with money you cannot afford to lose. Now, only 10% of 401k plans currently offer annuities to workers, according to the Plan Sponsor Council of America. Employers have certain legal obligations to ensure the 401k investments they offer are in workers' best interests. So relative to annuity providers, employers must ensure that insurance companies are financially strong and able to make annuity payments decades down the road. The Secure Act extends legal protections to businesses that follow specific rules when selecting a 401k annuity provider. Employers can pick carriers that are in good standing with the state insurance department in which the insurer is based. Now, being that for the past few decades, people have been living longer than what Social Security was designed to pay out for, millions of new retirees are joining the ranks of Social Security benefits recipients now and in the coming decades. In time, the outflowing payments to Social Security beneficiaries will start exceeding what Social Security has in reserves. The Social Security Administration will then have a decision to make. It will have to rely more on the inflows from payroll taxes and possibly other funding measures, you know, those raising taxes things that we don't want to think about, in order to keep up its promised benefits payments to future generations of retirees. Before the pandemic crisis, Social Security was looking at its reserves being depleted by roughly 2035. But now, over 20 million people have lost their jobs as a result of the spread of the coronavirus. That is 10% of the U.S. workforce. Payroll taxes that would be pouring into the U.S. Treasury from everyone's paychecks have lessened considerably. And as a result, Social Security has been dipping further into its reserve funds in order to keep up its promises to retirees and other benefit recipients. So things are changing for Social Security. Teresa Ghilarducci is a leading retirement researcher and authority. She thinks the timetable for Social Security depleting its reserves has moved up. Based on her estimates, the date may have moved up 2 years. That means we have 13 years left until Social Security, the system of Social Security, is depleted. The financial meltdown of 2008 caused over 5% of all retirees aged 62 and up to start claiming benefits early. Why? Because they had lost their jobs and had no other meaningful source of income. History could repeat itself in the near future. In turn, that would be responsible for the reduction of time until Social Security runs out of reserves. However, this isn't a reason to panic. Beneficiaries will continue receiving their Social Security benefits payments just as Social Security has done for decades. Even if the reserves were depleted, it would still maintain payments to beneficiaries. However, the amount of monthly income they would receive might be reduced. So workers at every age have to take control of their financial future. Okay? At JenniferLangFinancialServices.com, we offer a free complimentary consultation, and we can help you with no market risk retirement planning strategies, along with asset management for your stock portfolio. If you aren't working with an experienced financial professional who understands retirement, there are upsides to seeking someone out right now. These are unprecedented times, and we are in uncharted waters. The guidance of someone who has been through some market cycles and has assisted many other people can help you have more peace of mind. Also, keep in mind that you can't take back many retirement decisions once you have made them. What we do or don't do in the present might have an impact on the future for years to come. With a financial advisor or agent's help, you can discover how to become more retirement ready, having a rock-solid plan for how you will be financially secure and confident even in unpredictable times. You wouldn't have to depend as much on Social Security and other things outside of your control for your retirement income. So to sum it up, your money needs to work for you. It's taken many years of hard work to reach this point. Now, or when you are ready, you can start exploring the ways that your money can go to work for you. This starts with answering these questions. First, do you know whether you need to protect your money now so that you can have a comfortable retirement? 2, do you have enough income each month to enjoy your retirement lifestyle? 3, do you plan or do you have a plan that once you are retired, you have the choice to stay retired for good? 4, can you live your retirement life on your terms? At JenniferLangFinancialServices.com, we can help you cover these important questions and make the most of your money for your golden years. Don't be afraid. Take action and be confident. Good days are ahead. We just have to take the necessary steps to reach them now.
Well, thank you, Jennifer, for all of this wonderful information that you have provided us today.
You're welcome, Marcus. It was a pleasure. It was a pleasure indeed.
Ladies and gentlemen, please do take the time to share this wonderful episode recording and this information with a friend or a loved one. You have just tuned in to the show episode recording. Thank you and have a good one.
With today's economy, managing your finances and staying on track with your goals is not a simple undertaking. At JenniferLangFinancialServices.com, we've got you covered. With life insurance-backed options that can provide more benefits than a traditional 401k. We offer annuities, 401k rollovers, and no market risk retirement planning. Visit us online today at JenniferLangFinancialServices.com for a complimentary consultation. Agents now available in your state.